What does it mean when the man who predicted the 2008 financial crisis sells his entire portfolio and leaves just one stock standing? That's the move Michael Burry just made. The big short investor has dumped almost everything, holding on to just one name, a global titan in the prestige beauty industry. That's the puzzle we're here to solve today. Is this iconic company a golden opportunity or a classic value trap? That's exactly what we're here to figure out. We believe the best way to get to the truth is through a head-to-head debate. Our goal is to break it all down so you can make smarter, more informed investment decisions. The more we argue, the clearer the picture gets.
Hey everyone, the question before us today is a simple one. Is the stock of Estée Lauder a buy? I'm here to argue a definitive yes. I believe that Estée Lauder represents a classic case of a world-class company trading at a discount with a clear path to a powerful rebound. First, for anyone unfamiliar, let's quickly paint a picture of what Estée Lauder actually is. This isn't just one brand, it's a global powerhouse of prestige beauty. We're talking about a portfolio of over 25 iconic names that you all know and trust, brands like MAC, La Mer, Clinique, and Tom Ford. Their business is well diversified across skincare, which is their largest segment, as well as makeup, fragrance, and hair care. And their reach is massive, operating in about 150 countries and generating over $15 billion in annual sales. So, to put it simply, Estée Lauder sells the trusted high-end beauty products that people desire almost everywhere on the planet. Now, with that picture in mind, let's talk about why this stock is an attractive buy right here, right now. First, and this is crucial, their profit margins are moving up again. Despite a challenging year for sales, their gross margin in the last quarter expanded significantly to 75%. That tells you they have pricing power and are managing their costs effectively. This isn't a company in crisis, it's a company getting leaner and more efficient. Second, there's a turnaround in progress under new leadership. The new CEO has a clear plan called Beauty Reimagined. It's focused on faster innovation and fixing the issues in the travel retail business. Management is confidently guiding for a return to sales growth by fiscal 2026. Third, even in this tough environment, they are gaining market share in key regions like the US, China, and Japan. This proves their core brands are still winning over consumers. Fourth, the stock is fundamentally undervalued compared to its history. The share price has fallen significantly, meaning you can now buy these premium luxury range brands for a mid-range price. Great investors look for moments just like this. And on that note, it's worth mentioning that big short investor Michael Burry has made Estée Lauder his single largest holding. That is a massive vote of confidence in its deep value potential. And finally, the company remains committed to its shareholders. It has paid a dividend every single year since 1995, a track record of reliability. But the short-term numbers are only half the story. The real strength lies in Estée Lauder's enduring competitive advantages, what investors call moats. Their brand equity has been built over decades, giving them power that rivals can't just replicate. Their global scale and control of department store counters and e-commerce give them unparalleled reach. And their innovation engine keeps creating hero products like Advanced Night Repair that command customer loyalty and high margins. So, in closing, we see a world-class company with iconic brands, improving profitability, a clear turnaround plan, and a discounted valuation. The headwinds it's facing are temporary, but its strengths are permanent. For all these reasons, the answer to today's question is a clear and confident, yes, Estée Lauder is a buy. Thank you.
Thank you. My opponent paints a rosy picture, but let me bring you back to reality with the hard facts. The question isn't whether Estée Lauder makes good products. It's whether buying this stock makes financial sense. And the data shows it absolutely does not. First, let's address that 75% gross margin claim. Yes, margins improved, but only because they fired up to 7,000 people and slashed costs. Strip away the accounting tricks and you'll see this company is still struggling financially. While they managed to post a $159 million profit in Q3 2025 with an EPS of $0.44, this represents a 52% decline from the previous year's $0.92 per share. More importantly, their trailing 12 months show a massive net loss of $871 million with a negative EPS of minus $2.42. That's not efficiency. That's a company barely keeping its head above water quarterly while drowning annually. Second, about Michael Burry. My opponent failed to mention something crucial. Burry's investment is only $13.2 million, pocket change for a fund his size. Meanwhile, he's betting $75 million against Chinese stocks, the exact market Estée Lauder desperately needs for recovery. Burry isn't backing this company. He's hedging against the region that represents 31% of their sales. Third, the numbers don't lie. Revenue has collapsed 10% year over year to $3.6 billion, with organic sales down 9%. The travel retail segment cratered 28% year over year, shrinking to the low teen share of total revenue. This isn't temporary weakness, it's structural decline. Fourth, about that undervalued claim. The stock trades at a P/E ratio of negative 35, meaning they're losing money. Their debt-to-equity ratio has exploded to 168%, while debt increased to $7 billion. In 2024, they've cut their dividend by 47%, and management withdrew their full-year guidance because they can't even predict their own business. Finally, the growth in 2026 promise comes with a massive caveat. It depends on meaningful resolution of recently enacted tariffs. With trade tensions escalating, that's wishful thinking, not investment strategy. The bottom line: this is a company in decline, drowning in debt, and praying for a geopolitical miracle. That's not a buy, that's a value trap. Thank you.
Thank you to my opponent for highlighting the very challenges that create this exact buying opportunity. A great company facing temporary, well-understood problems is precisely what value investors look for. Let's be clear. My opponent calls the cost-cutting a sign of weakness. We call it decisive leadership. This isn't just about saving money. The profit recovery plan is part of a bold strategic vision to restore sustainable sales growth and achieve a solid double-digit operating margin in the coming years. It's a plan with tangible results, including a 50% reduction in excess and obsolete inventory over the past year. They are clearing out old inventory and resetting the business for long-term health, not just short-term appearances. Second, my opponent dismisses the numbers, but let's look at the numbers that matter for the future. While the travel retail business in Asia is undergoing a strategic reset, the rest of the business is already showing signs of life. Organic sales trends outside of that travel segment are improving sequentially. Key brands like La Mer, Clinique, and The Ordinary are driving prestige beauty share gains in strategic markets like the US, China, and Japan. This proves the underlying brand power is intact. Finally, my opponent wants you to focus on what the company can't control, like geopolitics. We urge you to focus on what it can control: innovation. Management is reorganizing its R&D structure to prioritize speed to market and accelerate product launches. This isn't a company praying for a miracle, it's a company actively building its own future. When you look past the temporary headwinds, you see a world-class leader with powerful brands taking the right, tough steps to emerge stronger. That isn't a value trap, that is the definition of a compelling investment. Thank you.
Thank you. My opponent calls this a buying opportunity. I call it trying to catch a falling knife. Let's get real about their decisive leadership. First, that profit recovery plan isn't a bold vision. It's a billion-dollar cleanup operation for a mess they made. They're spending up to $1.6 billion on restructuring because of a massive forecasting failure. The reason they had to clear out so much old inventory is because they completely misread the market, especially in China. That's not leadership. That's a costly reaction to a crisis. Second, my opponent wants you to ignore the travel retail business. Let me remind you, that segment used to be 28% of their entire company. You can't just amputate a third of your business and pretend you're healthy. And while they boast about brand strength in China, they ignore the reality on the ground. Chinese shoppers are flocking to local sea beauty brands like Florasis and Proya, which are faster, cheaper, and more culturally relevant. Estee Lauder is losing the next generation of consumers. Finally, they talk about innovation and controlling their future, but their own management admits they can't control the biggest risks. This is a company that gets 70% of its revenue from outside the US. They specifically cited potential tariff increases as a reason for firing thousands of people. My opponent wants you to ignore geopolitics, but the company's own leadership is telling you it's a primary threat. So, what do we have? A company paying $1 billion to fix its own mistakes, losing ground to agile competitors in its most crucial market, and admitting its future depends on global politics it can't control. This isn't a compelling investment, it's a company in turmoil. Thank you.
Thank you. My opponent wants you to focus on the rearview mirror on the problems of the past, but great investments are made by looking forward. Let's be very clear. Every single risk my opponent mentioned, the challenges in China, the travel retail reset, is already known by the market and reflected in today's discounted stock price. What the market is underestimating is the strength of this company's reaction. They are taking decisive, if difficult, steps to fix the business. Their profit margins are already expanding, and iconic brands like La Mer and Clinique are still gaining share. Investing is about buying a great business when it's facing temporary trouble. Today, you have the rare chance to buy a portfolio of the world's most desired beauty brands, led by a new team with a clear recovery plan at a price that already accounts for the risks. This isn't a company in turmoil, it's a leader in the middle of a comeback. The smart move is to buy before that comeback is obvious to everyone. Thank you.
First, these aren't problems of the past, they're problems of the present and future. China's economy isn't magically recovering, and Chinese consumers aren't suddenly going to abandon local brands for expensive American cosmetics. The travel retail business isn't resetting, it's permanently smaller because business travel patterns have fundamentally changed since COVID. These aren't temporary headwinds, they're new market realities. Second, about that discounted price. When a company is losing $871 million annually and carries $7 billion in debt, it's not discounted, it's distressed. The stock has fallen because the fundamentals are broken, not because the market is being irrational. Value investors don't buy companies that are bleeding money, they buy profitable companies at cheap prices. Finally, this clear recovery plan comes with a huge price tag. They're spending up to $1.6 billion and firing 7,000 people just to get back to where they were. That's not a comeback. That's expensive damage control. And even their own management won't give you a timeline for when this will actually work. The bottom line, a falling stock price doesn't automatically make something a bargain. Sometimes it's just a warning. Don't confuse a value trap with a value opportunity. Estee Lauder is not a buy. Thank you.
All right, judges, it's your turn. What do you think? Also, I've done my best to fact-check the information you just heard, and you can find the relevant links in the description. And hey, don't just vote, tell us what you really think down there in the comments too. We love hearing your takes. I believe every viewpoint will bring something valuable to the table. Before you go, don't forget to hit that like button and subscribe. Your support means a lot. See you next time. Bye!